Better System Trader, episode 31.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 31, and I'm your host, Andrew Swanscott. This week's guest is Greg Morris. He was the Senior Vice President, Chief Technical Analyst, and Chairman of the Investment Committee for Stadion Money Management, overseeing the management of over $5.5 billion in assets. He's been featured in the media a number of times and has also been invited to lecture about technical market analysis around the world. He's currently semi-retired, serving as a consultant and working on a few projects, including his golf. Now, in this episode, we talk about the real definition of risk and how to manage it. We also discuss the applications of market breadth, the importance of indicator diversification, and how the weight of the evidence concept can be used in trading. So let's get into it. Hope you enjoy the chat with Greg Morris. Thanks for joining us today, Greg. Now, you've had quite an interesting path leading up to trading, so can you give us a little bit of background into yourself, and then we'll dig into the trading side?
I'd be delighted to. I started investing in the mid-'70s. I bought a couple of stocks that had great earnings reports, paid a dividend. I mean, they just sounded so good. They just couldn't do anything but go up. That was in the fall of '72. Your older listeners will know that in January of '73, the market had peaked. And that's when Alan Greenspan said there's probably never been a better time to own stocks. And the market went down for the next 2 years, went down about 70%. I held them all the way down because I had no plans, I had no stops, I had nothing. All I know is that the fundamentals just got better and better. And being an engineer, an aerospace engineer, I decided that there's got to be a better way. And I've read a book on technical analysis by Michael Zahorchek, and it talked about a process. It talked about calculating moving averages on a weekly basis. And it had a process written down with rules to follow. And I said, this is for me. And I've been a technical analyst ever since. I was with Norm North at N Squared Computing most of the 80s and early 90s, developing technical analysis software. Then in the mid-90s, John Murphy and I joined up for Murphy Morris. And then we sold Murphy Morris to StockCharts.com. And I went and managed money with a company called Stadion, which used to be called PMF. I did that for the last 15 years, just retired at the end of last year. And my good friend Chip Anderson at Stock Charts asked me to start writing the blog, and I'm just enjoying life in kind of a semi-retired state. If I said any more, it'd take too long.
No, that's fine. Thanks for sharing that, Greg. So for those that aren't aware, you've published a number of books, and the most recent one is Investing with the Trend.
Yes.
Now, in that book, there are a number of points that you made that I thought were quite interesting. So I'd like to ask you about a few of those today, if you don't mind.
Certainly.
We'll just start with risk, because in the world of modern finance, risk is often defined as volatility. Do you think that's an accurate definition of risk?
Well, my usual response to that is hogwash. That's a big fat no. Volatility will contribute to the upside just as much as it contributes to the downside. In fact, in the world of finance, they say that standard deviation is the measurement of volatility and hence the measurement of risk. Well, standard deviation then means you adhere to the principles of modern finance, which starts out with the assumptions that investors are rational, the markets are efficient, and returns are random and normally distributed. And I think anyone who's been involved in the markets for more than about 15 or 20 minutes knows that none of those are factual. So if you start out with those assumptions, how can you end up with something, a valid process. So risk is the loss of capital. Just about any client who looks at their January statement for the previous year and sees standard deviation of 0.65 and you lost 30%, they know what risk is, and they're not going to ask their advisor what that standard deviation means. They know they just lost 31%. So that's what risk is. If you live in an ivory tower of modern finance or the sterile laboratory of modern finance, then you might be able to say, okay, well, standard deviation works best for our models. But most of these people don't trade. They don't make investments. They just talk about it. So I know that's a long answer, but what I'm trying to say is risk is loss of capital, not volatility.
Yeah, so there are obviously a number of theories or approaches to controlling risk, and we won't go into them all today, but one of the common approaches is diversification. What's your opinion on using diversification as a solution to managing risk?
Well, there's an old saying that when the market starts down and it's a good, solid bear market, that correlations move rapidly toward one, which means everything goes down. And if you look in 2007 through March of 2009, everything was very correlated and it all went down. So diversification didn't help very much during that bear market. However, in the previous bear market from 2000 to 2002, where it was a very selective declining market, mainly dot-coms and technology, and diversification would have helped there. So diversification, they say, is a free lunch. Anytime you can do it, you should, but that should not be your sole method of protecting yourself from risk. You should be using stops and money management techniques also.
Okay, so one of the another common approach, I guess, is rebalancing positions. Do you think that can be used to reduce risk?
Well, I have a problem with that, and I'll tell you why. When you rebalance, say let's just say once a quarter, let's say you've got 10 stocks or 10 holdings, and they're very diversified, and you rebalance. What that tells me immediately is you really don't know what you're doing. What you're doing is you're selling the issues that have performed the best, and you're putting that money into the issues that have performed the worst. Now, that just on the surface sounds flawed to me, especially if you're a momentum person or you're a technical analyst. We buy strength. We sell weakness, and so that's just the opposite of what rebalancing does.
It's interesting the way you put it. It kind of sounds really obvious that way.
Well, I don't hold back. I've been doing this a very long time.
Okay, so you've already kind of touched on this. So what do you think is the solution for when market risk reaches certain levels?
Well, I'm a trend follower. And as a trend follower, I have a number of trend following indicators based on price, breadth, and relative strength to help me know what the market is doing. And to be a trend follower, you first have to decide what's the minimum length trend you want to follow. You can't just say that without defining that. You have to say, well, I want a trend of at least 15 days with no pullbacks greater than 4% or whatever. You have to define that. And then you create indicators with parameters that meet those goals. And so as a trend follower, I don't try to measure risk per se to determine what to do. I just follow the trend, and I have stops. I keep stops myself. I don't put them out with the brokerage firm because that's a good way to lose things. But the other thing is in money management, I see a lot of people that will tell their clients that they have stops, and then if the price gets near the stop, they'll hold an investment committee meeting to decide whether to follow it or not. And I think that's part of the big flaw out there. If you've spent all this time determining where to put a stop, when it hits that stop, execute it. And that's the discipline that's required to be successful as a trend follower.
Okay. All right. Thanks, Greg. Now, I'd just like to switch topics a little bit to a concept in your book, which I think could be very valuable for a lot of traders and investors, and that's the concept of weight of the evidence. Could you explain what that concept is?
Certainly. I stole that term from Stan Weinstein, who wrote a newsletter starting in the 70s, called the professional tape reader. What it is, as a trend follower, we have a basket of indicators designed to measure price movements, designed to have breadth measure price movements, and another area is the relative strength of things like small cap versus large cap, growth versus value, et cetera, which is good in trend following as a confirmation indication more than a specific timing event. And so this weight of the evidence is let's say we have a dozen indicators that we like to measure the weight of the evidence, and they're all based on price and breadth, and then a little bit on relative strength. And based on their performance in the past, we assign weights to each one of them, so that the sum, if all 12 of those indicators were saying we're in an uptrend, then the total would be 100. And if they were all saying we're not in an uptrend, it would be 0. So obviously, since they're looking at different things over different time frames, you'll have a number that goes between 0 and 100, and that's the weight of the evidence. And then you divide that weight of the evidence up into segments, say from 0 to 30, 30 to 60, and 60 to 100. And you do that with a lot of testing and past examination. And you set those zones, and so that those zones then control the buying requirements. I only deal with ETFs, what you can do with stocks also, but if you're in that lower zone, which means that less than 30% of your indicators are saying you're in an uptrend, then I want to have very rigid buying requirements. I want to buy ETFs that are already proven that they're rising, and again, using technical indicators to see that those ETFs are in an uptrend. And then that zone tells me what the stop is, and the stops are going to be really tight down there in that lower zone. I have a saying that I know I'm going to be wrong at times, but I'm not going to stay wrong. And I think that's where a lot of people fail. They think they're right and the market's wrong, and that's a good way to find another job. Then as the trend matures, as the trend continues to build, you go up to the next zone, and that changes, that probably loosens the buying requirements, and it also loosens the stops a little bit. And then you get up in the top zone, which I call the green zone, and then pretty much everything is available to be bought, and the stops are at their loosest point. And so that's how that weight of the evidence, it's a fairly simple concept. It just requires a lot of discipline.
Okay. So the first component you mentioned there was price. What are you looking for price to do, and how do you measure that?
The simple answer is go up. That's not what your listeners are looking for.
No.
I have a number of price measurements. For instance, stochastics. Let's talk about percent D, which is the 3-period moving average of percent K, the raw stochastics. Stochastics is a very good trend indicator. I'd say that if you looked at it in a very simple basis, anytime stochastics is above 50, you are in an uptrend. And you set the length for stochastics based upon the trend length you want to follow. So if you look at a stochastics of 15 or 16 days, and it's above 50, I guarantee you can open up a chart and you're going to see those prices are in an uptrend, because stochastics is always looking at the current price relative to the range of prices over the last 15 or 16 days. Stochastics is a great trend indicator. However, most people don't use it that way.
Yeah. So obviously then you think it's important to test these indicators outside of their normal parameters just to see how they perform.
Oh, yes. The testing process is long, hard work. And what you have to do is you have to approach it kind of like an engineer would approach a project, without emotion, and do not optimize unless you know exactly what you're doing with optimization. That you will fool yourself horribly with optimization if you don't understand in-sample and out-of-sample data. There's some pretty good books out there on optimization. None of them come to mind right now, but I would say that a lot of software has the ability to optimize, and that's probably the most misleading thing you can do is just go into it blind and say, oh, look, this moving average crossover is the best there is over the last 12 years. Well, you're going to have a real disappointment.
Yeah, thanks, Greg. So the second component you mentioned there was market breadth. Now, for those who may not be familiar with that, could you give us a quick explanation on what that is?
Sure. Market breadth is the internal structure of the markets. I'll talk about the U.S., the New York Stock Exchange components. They look at each stock. Each stock is treated equally when you're dealing with breadth. Its breadth is like the advances and the declines, the up volume, which is the volume of the advances, the down volume, which is the volume of the declines, and then the new highs and the new lows. Now, the advantage of breadth is it treats every stock equally. For instance, ExxonMobil, I think it's probably one of the biggest stocks on the New York Exchange. It could be up $50 one day, but that only count as one advance. And Freddy's Pizza, the smallest stock on the exchange based on capitalization, could be down a penny, and that would be one decline, and they would just cancel each other out. If you think about the markets, everybody's watching these large capitalized indices like the New York Stock Exchange Composite, the NASDAQ Composite, the Dow's price-based, S&P's cap-weighted. Only the top 10 or 15% of the stocks are moving that index. All the rest, because it's based on capitalization. I think at one time in the NASDAQ 100, the top 10 stocks attributed to 43% of the movement of the index. And so, to me, that's misleading. And that's why at market tops, these long, drawn-out periods of distribution, this is where breadth really comes into play. Because as the markets roll over from going up and start going sideways, people, I think, have a natural tendency to move from their riskier holdings into what they perceive to be safer holdings, like large caps and blue chips. I think it's a fairly normal process to see that. Well, and that act right there, if you're following capitalization-weighted indices, which most are, that keeps those indices rising because people are putting money into those large cap stocks. Breadth, on the other hand, which represents the small caps and the mid caps and the large caps equally, will start deteriorating. And you'll see this big divergence of breadth relative to cap-weighted indices at market tops. And it's a signature that has always been there, but the problem is that signature occurs often when it isn't a top. It's kind of like the index of leading indicators calling 25 of the last 15 recessions. So it's a great tool, and it's almost always there at every top, yet it has a lot of false calls. And so you have to understand how to use it. Breadth is a tremendous component to have in a trend-following model for that very reason. The Tom McClellan says that breadth arrives at the party on time, but it always leaves early.
I like that. So it sounds like there's different measures of market breadth. So how do you choose what works for you?
Well, I use all the components. I have an advanced decline component, and I use it in a manner similar to the McClellan Summation Index. I don't use exactly the same parameters that Tom uses, but the McClellan Summation Index is a great indicator. I wrote a book on market breadth 10 years ago, yep. And I dedicated an entire chapter to the McClellan indicators. And in fact, I'm rewriting the book. It's going to be available on Kindle here next year, and with updated charts. That one of the things about breadth that people need to firmly remember is that new highs and new lows are totally different animals than advances, declines, up volume, down volume. Advances, declines, up volume, down volume are based on the previous day's action, period. New highs and new lows are based on the price a year ago, 52 weeks ago. You can't treat them the same. One is a very longer-term reflection versus the other. But I use them all. The up volume, down volume measures tend to work better than the advanced decline measures. I've got one that uses both up volume, down volume, and advanced declines. So yeah, breadth is probably 40% of my model.
And do you find that the different types of market breadth measures are better suited to particular trading styles or timeframes?
Well, probably. That's not much of an answer, but I know that long ago I used the New York Stock Exchange breadth, and in the last 10 years I do nothing but NASDAQ breadth. And the reason I do that is because in 2001, Dick Grasso, who ran the New York Stock Exchange, wanted to loosen the entry requirements for listing on the New York Exchange. And to do that, he opened the door for a lot of bond funds, preferred stocks, things like that. And what happened is that many of the new issues on the NYSE were more sensitive to interest rate changes than they were to equity changes. And when breadth doesn't care what it is. If it goes up, it's an advance. If it goes down, it's a decline. And I don't think the breadth data is as good on the New York Exchange as it is on the NASDAQ. The NASDAQ is a wonderful high beta index for a trend follower to use because it goes up faster and it goes down faster. It's got everything in it, large cap, mid cap, micro cap, small cap. It's got almost all the sectors. Probably the one area that it doesn't seem to have a good representation is in the financials. But it has dogs. It has everything. So I follow strictly the NASDAQ breadth now. And I use the NASDAQ composite for my price measures.
Okay. So it sounds like there's a lot of different measures there. If someone wanted to get started in studying market breadth, how would you recommend they approach that?
Well, I could selfishly say they could wait till the first of next year and buy my book. I'll tell you, the reason I wrote the book is John Murphy, Martin Prang, all these folks that wrote these huge technical analysis books, they generally dedicated only a chapter to market breadth, and I thought that breadth was so important it deserved its own book. And so any of those books talk about breadth very well. Another book is Charles Kirkpatrick's called Technical Analyst. That's an excellent book also, and he covers breadth very well. You got to be careful searching the internet. Before you read someone's article, you ought to read about the person who's writing it first to see if you want to even care what his opinion is.
Yeah.
I strongly recommend that. Make sure you're reading from people who actually go out there and trade with real money. There's a lot of storytellers. There's a lot of newsletter writers that probably have never traded. They just like talking about the markets. And those are, while you may learn something, you need to stick with practitioners, people who make real trades with real money.
Yep. Well said, Greg. So the third and final component in the weight of evidence approach you mentioned was relative strength. Mm-hmm. So what are you comparing strength against?
Well, I have three relative strength measures, and one of them is small caps versus large caps. And if small caps are outperforming large caps, then that's good for trend following because it represents speculation. And speculation is required for markets to go up. People need to speculate, and generally small caps will outperform large caps in good bull markets. Same way with growth versus value. Growth is probably a little more speculative than value is. And then the other thing I look at is a price to breadth relative strength. Take a breadth measure and compare it to a price measure. And again, because the breadth represents equally and would include a lot of the small and mid caps, if it's outperforming price, then that's also a good positive trend measure. Now, I have found that these are not good for helping determine the beginnings of trends and the ends of trends. What they are best at is confirmation that, yes, we are in a good uptrend now because relative strength is showing that. But you wouldn't want to use them to pick the beginnings of trends because they'll always be late. And that's the other thing about trend following. You're always going to be late. You're not picking tops and bottoms. You're waiting for the market to tell you that it's going up, and you're waiting for the market to tell you it's going down.
Yeah, and so onto indicators. I think you mentioned earlier that I don't recall the exact number. I think you may have said you have 10 indicators in your model. How do you manage to select indicators that are giving you a different part of the picture rather than doubling up on more of the same?
Well, that's a great thing to comment. That's called multicollinearity. It's a big word. For instance, here's a very short, simple example. If I see a chart that someone has created and it's got, say, a 14-day %K stochastic on it and a 14-day Williams %R, then I will say that these people don't know what they're doing because those are the same indicator exactly. One is just the complement of the other. In other words, if one is at 100, the other will be at 0. If one's at 50, the other will be at 50. If one's at 25, the other will be at 75. In other words, you're getting no new information by using both of them. Either one of those work great. They're great indicators, but you don't need both of them. Same way with volume-based indicators. I've kind of gotten away from volume-based indicators altogether because I don't think the volume is as reliable as it used to be when all exchange volume was reported. Now we've got all sorts of trading going on outside of the exchanges. Yeah. But again, if you get a basket of volume-based indicators, they're all going to be telling you the same thing. So make sure you have. Now, you mentioned diversification at the beginning. This is where you need diversification. You need diversification in your indicators. For instance, I have 3 price-based indicators, but they look at different time periods: short, medium, and long. And those are terms that, depending on what kind of trend following you're doing, how you set the parameters. And then the breadth is diversified because I'm not looking at just advances and declines. I'm looking at all of it. And same way with relative strength. So diversification of indicators is very important, so that each one is telling you something differently than all the others. Yeah. And what do you do if you notice that over time one of those measures is losing its ability to identify a trend? Well, you first of all, you need to be prone to not tweaking your model once you've got a model that you like. It's not going to work flawlessly. If you're looking for the perfect model, you're going to spend the rest of your life looking. You have to just accept it on face value. But there are things that will start fading out. I used to have an interest rate component in my model. This interest rate component, I don't remember back in the 80s, in the 70s and 80s, if interest rates went up, that was bad for the market. If they went down, it was good for the market. Well, that's not the case anymore. You have to really have it close one eye and then squint with the other one to see that in today's market. And so an interest rate model, especially with rates not moving in the last 7 years, here in the States they've been down to almost nothing since 2009. So that's the type of component that needs to be replaced. And I'll tell you what I did with that one. I replaced that one with an adaptive trend measure. In other words, a trend measure that's looking at price, but it also takes into consideration the true range of the price movement. In other words, kind of the volatility of the short-term price movement. So, yeah, you need, but I want to caution people, the first time you think something isn't working, that's probably the wrong time to change it. All of those are going to have bad periods. And you got to be very careful not to just jump in and start tweaking your model. Long-term capital did that in '98. There was a big bullish market, and they're looking for price discrepancies, and they made a killing. I think they had $130 billion under management. These are all these finance guys, Merton and them, and their models. When in '98 the market started peaking. Most people think it's 2000, but all the small caps and mid caps started down in '98 and '99, and only the .com large caps, high tech, kept going up. large cap growth. And anyway, their model started failing, or so they thought, and they started tweaking it. Well, they almost took the New York Fed out with them when they finally got bailed out. You got to be very careful about tweaking a model. Spend all your time creating it, and then just believe it and trust it. And that discipline, you didn't mention that, Andrew, but let me comment on discipline.
Okay.
It is an absolute critical component to be a successful trend follower. I think it's a critical component to be successful in anything to do with the market. If you don't have it, you're probably not going to make it. I always like to tell this little story about I've been on a diet my entire adult life, and I was driving up in the mountains last spring with my wife, and we stopped at an old filling station, a gas station, and it was one of those old ones that you couldn't pay at the pump. I had to go inside to pay for the gasoline. And while I'm in there, I buy myself a candy bar. I knew my wife didn't want one. I'm walking back out, and I'm getting this look through the window. And I get in, I sit down, and she says, "You just don't have any discipline." And I said, "That's not true, because you don't know how many of these I wanted." Now, the reason I tell that story is because discipline is not a knob or a lever that you can just get up and say, "Well, I think I'll be disciplined today." No, you either are disciplined or you are not. And if you are not, you're going to have a real tough time making money in the markets.
Yeah, that's great advice. Yeah. I get the same thing when my partner comes home with a pair of shoes, and I know that she probably wanted to buy 3 pairs. So.
That's right. And for all you know, she did.
Yeah, that's right. I've got to check the credit card statements. So I just want to ask you about, earlier you mentioned something about the weighting of these indicators in the model. Can you give us a bit more information about how you go about weighting them?
Yes. What you do is, for instance, this is not one of mine, but let's use a very simple example, like a simple moving average crossover with price, okay? Simplest form of technical measure there is. And you go back and you come up with a parameter for that moving average. Let's say you're looking at the NASDAQ composite. You have to decide what you're going to be trading to do this on. And let's say a 65-day exponential average just tends to work well for what you're trying to accomplish. In other words, the whipsaws they're going to be there, but they're minimal. The stops, if you use the average to generate the stops also, then you have to say, well, that's acceptable. In other words, you've gone back and looked at many, many, many averages without optimizing. If you do this manually, you'll do much better and do it visually. And then you say that 65 exponential average over the NASDAQ composite is one of your price indicators. Mm-hmm. And then you do the same thing with your breadth indicators and your other price indicators and your relative strength indicators. In other words, you look at various parameters. Let's say the McClellan Summation Index. Let's say Tom and Sherman used 19 and 39 exponential averages. Well, try different moving averages. Also, consider using a ratio-based. Instead of advances minus declines, look at advances minus declines divided by total issues, so that over time the data will stay fluid. And to set the weighting of those parameters, I want the parameter that has performed the best. And I'm not talking about the best based upon if I traded just that one. I'm talking about the minimal whipsaws, the less drawdown, and the performance. In other words, all the things that indicator can do to your account. And that's the one I want to weight the most. And of the indicators I use, the one that has the most weight gets 25 points out of the 100. It's 25% of the movement. And then the smallest one is 5 points. In other words, it doesn't contribute too much, but it does contribute. So you can set it to any values you want, but that's how I went about doing it. The best performing indicators got the highest weighting. If they, not performance based on the returns they generated, but the whole package of what it was doing, the whipsaws, the volatility, the stops, everything.
Okay. All right, thanks, Greg. I'd just like to switch pace a little bit now and ask you about a post that you published on your blog comparing driving and investing. I thought it was a really nice analogy, especially because most of us can relate to driving. So would you mind sharing some of the ideas in that article with us?
Well, sure. I write this blog for stock charts called Dancing with the Trend. It's free. Anybody can read it. And I'm always trying to generate analog-related stories with something people are familiar with investing. And that one was one of, I called it Avoiding Potholes on the Investment Highway. And then I have different things like frequent lane changers. I know that down there you don't drive on the correct side of the road, but it's still appropriate here.
Yeah.
I'm sorry, I couldn't pass that up.
Okay.
I've noticed when I'm driving in traffic, you'll see I'm the kind of person who will just stay in a lane knowing that by the time I get to my destination, it's probably going to get there at the same speed as all the others. Yet you're seeing all this relative motion around you. And I see people changing lanes constantly. Just they think they're getting ahead. Well, but what I also see is they're doing a couple of things. One is they're putting themselves at risk of an accident every time they change lanes. And the second thing, and the thing I notice that happens more than anything, is that they will change lanes and they haven't looked down the road a bit. And they'll pull over into a lane that's already stopped. Just because there's an opening in it. And I just think, my gosh, if they'd just looked 400 or 500 feet down the road, they would have seen that that's not a good lane to get into. Whereas I'm the kind of person who just stays there. And I think that's, as a model follower, someone who builds models and follows them, that kind of goes along with the way I drive. When I'm not out looking for lane changes all the time. I'm always not looking for new indicators. I'm not looking for this and that. I've been there, I've done that. So that's an example. And then the luxury car concept. I spent a lot of my life in Dallas, Texas, where traffic is horrible on big freeways. And it seems like everybody's driving these big Suburbans and these big SUVs. And, you know, with cars today, with the soundproofing and everything, and the radio, the music that you can play with the 30 speakers in the car, and they're quiet. The cars are very quiet when they're driving, and I think people do not have any concept of speed with that mass that they're in. Everybody needs to go somewhere where they take a car and run it into a brick wall at 20 miles an hour, and you'll see that car just completely totaled. And they're out there driving 70 miles an hour, not paying any attention. And it's because most of the cars are going the same speed, so your feel of speed is that relative motion and not the absolute motion. But anyway, that's more opinionated than it has to do with investing. But it's just something, when I was talking about driving versus investing, I see that a lot. And the reason why I tie that in is because here we are 6.5 years into a bull market. This is kind of like driving a luxury car for a buy and hold investor. You know, it's been pretty darn good. The last year and a half has been a little not very great, but this is like driving a luxury car. You just buy and hold, and they're forgetting the history, and they're forgetting that this market, we're going to have a bear market. We may be in it. I don't know. I don't forecast. But we're going to have another one, and this buy and hold investor is going to suffer immensely. And if he's in his 60s and he's minimally capitalized for retirement, he's going to be devastated. Whereas a trend follower, where you have stops, you'll have periods where I call it frustration, but you'll never have periods of devastation. And that's a big difference. So I beat that to death, didn't I?
No, that was good. And tied in nicely to my next question. So I was going to ask, I know your opinions on forecasting, so I won't ask you where you think the stock market could be heading, but I will ask you, what does your analysis tell you about the current state of the market?
Well, got out, I can't remember the dates, but I'm back in now. Probably 2 weeks ago, started legging in. When you have a model and the weight of the evidence starts to build, you also have asset allocation percentages that you want to put in. You might go in with 20% initially when you have the very tight stops, because, like I said, you know you're going to be wrong, but you don't want to stay wrong. And so I want to, if I'm wrong, I want out. I want back out. And you just have to accept that little loss. And so my model now is in yellow, which is above 50%, which means a pretty good model, so fully invested. The stops are at their loosest point. And like I said, I do not forecast because I'm absolutely positive there is no one knows what the market's going to do today, tomorrow, next week, next month, next year, or any time in the future. In fact, I wish forecasting had consequences. Kind of, it's like American baseball. 3 wrong forecasts, you have to change professions. And we would have a lot less of that noise on financial media, which is another subject altogether. Nothing but noise. There's nothing that's been said on financial television of any value to a technical analyst.
All right, thanks, Greg. Well, I'd just like to finish up now with some quick closing questions.
Sure.
What's the biggest lesson you've learned through trading?
The biggest lesson is that I'm not a day trader. I tell people I have some master's degrees in what not to do. If you don't learn from your mistakes, then you don't get a master's degree for it. I was trading gold back in the 80s, futures, and I was doing very well. Had an Apple II computer, and I had my indicators that were telling me everything, and I was going into a little strip shop center commodities firm, and I was trading so much they even gave me a little room with a little Bunker Ramo machine and bought me a subscription to one of the big charting magazines or books. And what happened was I built this account way up. I thought about quitting my day job and all that, and I stopped looking at my data. I stopped looking at my software the night before, and I thought I was just a gifted trader. And I just started ignoring the software. I'd go into there and trade, and in about 2 months, I wrote a check for $9,000 to close the account. In other words, it cost me $9,000 plus the $10,000. So I lost $19,000. Back in the early 80s, that was a lot of money for me. But I built the account up to 6 figures. And so I really, in my mind, I lost a whole bunch of money. But I learned a lesson. And that is, in Texas, we have a saying that dance with the one that brung you. In other words, it was the charting and the indicators that made me a successful trader at the beginning. It was not me going in there looking at a quote machine and just guessing about the future. And so whatever technique you find, stick with it if you're comfortable with it. So, like I said, you learn these things over time because you paid a price for them.
Yeah.
So I guess that kind of comes back to discipline. And I'll say it again, discipline has got to be one of the most important components to be a successful investor there is. Personal discipline.
You must have just read my mind, because I was going to ask you what do you think is the most important attribute for a trader to become successful. So.
Yeah, I think that discipline, because that discipline can be filtered off into the process you use. The other thing is have a process. In other words, when you have a process, by process I mean a procedure that you follow to make investments. In other words, you measure what the market's doing, you have a weight of the evidence system, you have a set of rules to tell you what to do whenever all the different circumstances arise. In other words, you're doing everything in your power to keep your human, frail emotions out of the process. Your emotions will fail you more than anything, and so you need to have a process written down that you follow so that you don't use your emotions.
Yeah.
And that's kind of tied back to discipline.
Okay, and what's the best way for listeners to get in touch with you?
comments go to the stockcharts.com, Dancing with the Trend blog, and there's places to write comments. And what I do is, and they can ask questions, and the questions I answer periodically. I don't respond to the comments on the blog, or I wouldn't have time to eat. So what I do is I take the questions, and then periodically I answer all the questions in another article. And that works very well and allows me to play golf.
Yep. Well, thanks so much for chatting with us today, Greg. Is there anything else you'd like to mention before we wrap up?
No, this was a great interview. I appreciate it, Andrew. You did a wonderful job. It's if the trend is up, dance with it. It's just that simple.
Yeah, cool. So thanks for spending time with us today and sharing some of your valuable insights. For those that haven't read Greg's book yet, it's called Investing with the Trend. He's got a couple of others as well. It's a great read full of loads of information and research, so I highly recommend that people check that out. I'll have a link to those books and to the Dancing with the Trend blog on the website.
It'll also help cure insomnia.
Well, if you're not into tables, yeah, there's loads of info in there and lots of good research, so check it out. Yeah, so thanks for your time today, Greg, and I wish you all the best.
It's my pleasure. Thank you, Andrew.
Cheers. Bye-bye. What a fantastic interview with Greg this week. Here are two of my favourite takeaways. Risk is the loss of capital, not volatility. I thought this statement for Greg was quite interesting because volatility is often classified as risk. However, Greg provided some arguments to demonstrate why risk is actually the loss of capital and not volatility. I also found the weight of the evidence approach quite an interesting concept. I won't go into it again here because Greg just spent time explaining it in detail, but it's an interesting approach for managing entries and exits and identifying the market regime. If you'd like to know more info on this week's episode, or just have a comment or question, head over to the show notes, bettersystemtrader.com/31. We have links and other details there. Anyway, that's it for this week. I hope you enjoyed the chat with Greg, and thanks for listening to Better System Trader. Catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.